Happy Monday, everyone. Our quote this morning says 90% of millionaires become so through owning real estate. That's a quote by Andrew Carnegie. If you could choose one asset to invest in for a long term, what would that asset be? For years, a company called Gallup has asked investors exactly that question. And since 2013, the most popular answer has been the same: real estate. This question was asked among three different class groups. You have lower, middle, and upper class. Lower class meaning anyone making under 40,000, middle class anyone making between 40 to 100,000, and upper class meaning anyone making 100,000 or more. I've always said, who doesn't know someone who bought a home a few years ago that isn't worth significantly more money than when they purchased it? Unlike stocks, bonds, crypto, which can all seem like temporary numbers in a bank account, real estate is a tangible asset. And if we're talking about long-term investment, we got to wonder, okay, what does that mean? What is the goal of the end investment? What am I trying to produce? Am I trying to produce income, long-term gains? Am I trying to produce wealth? Am I trying to produce security? What is it that I'm trying to obtain with my overall investment? For Americans, the best long-term investment doesn't seem to be necessarily the one that gives the highest returns. Usually it's the one that's a blend between high returns, safety, and stability. And then from there, if your home didn't value as much in the short term, remember, real estate is a long-term investment. Overall, with the blended rate of stability, investment income, aka ROI, and just safety, it actually surpasses the other investments. Real estate is versatile, whereas a lot of homeowners may be able to extract the equity from their property and put it towards buying another property. This is a strategy called house hacking, where a lot of investors use this in order to accumulate wealth. Remember, when you're looking at the return on your investment, always bear in mind that the money that you actually took to purchase the house, not the purchase price. If you're getting financing, this is your cash to close, your down payment, plus your closing costs. That's the amount of money that you actually took out of your pocket to invest. That is what you need to calculate your return on investments on, not the purchase price of the property, because you borrowed money for the purchase price. You never took that money out of your pocket. You have a loan on that property. Real estate still remains one of the top investments in the court of public opinions. Be very careful of the headlines that you're seeing that the media is pushing out, as it may not accurately reflect what the real estate market is. Remember, as I've always said, the media is there to trigger emotions, which equals better ratings for themselves. It's always a good time to buy. Yes, house prices are higher than usual, and interest rates are higher than they were a few years ago, but it's always a good time to buy. That's it for this week on Real Talk. See you on the next one.